Hey gang, Raghee here, and in this free recap video we're going to talk about what is macroeconomics, or what you're hearing a lot about, which is macro. All right, the reason we're hearing so much about it lately is for the past decade we've had a very singular monetary policy from central banks around the world, and that is to print money, print lots of it, buy assets, keep rates low, keep the dollar pushed out into the global and domestic system. Money supply. So at the heart of the way that I look at the markets, at the heart of how I gauge macroeconomics is the dollar. But before we even get there, let's talk about what macro is not, to really clarify this. Macro is not fundamentals. That is earnings. That is individual data points. Individual. Now, cumulatively, certain data points can contribute to an overall macro opinion. Headline psychology. Headline psychology is a soundbite. Headline psychology is something that we feel is a major headline for that day, for that session, that's moving price action, but it's not necessarily a data point. It's not really a fundamental. It's going to be something that will be a mix of maybe the other three, but it's really more about news, right? Headline psychology really is about news. The next is macro itself. Now macro, let's go back to this previous slide here. Macro is, what is the momentum? What is the momentum in interest rates, in GDP, in other words, growth? What's the trend or the momentum in monetary policy tone, as well as productivity? So GDP, productivity, interest rates, and even the tone of a central bank. But because before they act, they can definitely sound dovish or hawkish. They could be in favor of a loose monetary policy or a tight monetary policy before they actually act. So there's a certain macroeconomic measurement to that. And remember, macroeconomics really is, at the end of the day, a rate of change conversation. Right, so let's talk about what rate of change is. And I'm going to use the rate of change indicator as an example, although I don't use the rock, the rate of change. But let's talk about what rate of change is in its momentum. Right, but here's the key point. It's momentum from one period to the next. It's relative to the previous data point and the previous data point, so it's an accumulation. It's very much like watching a momentum indicator or trying to form a trend line with one touch point and another touch point and another touch point. And you're going back a certain number of periods. So the same way that I would look at a rate of change indicator is the same way that I'm going to look at the rate of change of macroeconomics. Now, the ones that I use, as many of you may know, and we did a special member webinar on this that's available for members in the member webinar playback section of the futures dashboard. But for those of you that did not catch this or aren't aware, I look at the market, and this is very much something that my mentor taught me really 30 years ago, and it really got honed after 2 decades of currency trading, because at the heart of this is understanding US dollar or currency liquidity, which is very much part of monetary policy. We have right now one part of this being shaken up because the FOMC is sounding, not officially, but sounding informally accommodative, or at least they're ready to pause the current tightening cycle. So while it's not actually a data point quite yet, it's one that the market is responding to. So notice I'm looking at very specific points within data. I'm not looking at jobs. I'm not looking at necessarily PPI. I think a lot of that is going to be factored into this, right? I could make crude oil a part of this, but that's going to be factored into this. I can make copper a part of this, but it's factored into inflation. So I'm trying to look at the largest umbrella that will take into account a lot of the markets that could contribute to my opinion about any one of these, and then we look at it from a momentum or rate of change standpoint. This is basic 101 stuff, gang. This isn't anything that I think most traders may not be aware of. They just may not know how to do it or what to measure, because it seems like data points and earnings. Notice earnings isn't here, right? Earnings is not here at all, because it'll eventually land here. Okay, so you'll notice I'm factoring on just a number of points. Now, every macro analyst is going to pick their points. I try to think like a central banker. So that's why I'll focus on these two. And that was from years and years of Forex trading. So I'll focus as a central banker. So again, think about what that kind of knowledge would do then to understanding your asset blend for your portfolio or even your watch list for trading. Each one of these has a particular set of markets and sectors that do well and that do poorly in each one of these stages, if you will, or cycles. And that's why for a trader it's so important. I think for an investor it's non-negotiable. If you're an investor, understanding this is absolutely non-negotiable. I think a lot of investors confuse, a lot of traders too, confuse macro with headline psychology, macro with fundamentals. And that's a huge error because they think they're looking at larger, more impactful points, when in reality, they're going to get just whipped around by the way these two operate. So it's a very different conversation. I hope this clarifies this for a lot of you. And again, there's a lot of different points that people can look at. But again, think about what macroeconomics measures. It's not about headlines. It's more about, it's not even about earnings, and it's not about singular data points. It's about the momentum of the data points, specifically things like productivity, growth, rates, and to me, even the tone of a central bank. All right, hope that helps. I'll see you in the next update.